So our next question is, I'm concerned that adding my pension as an additional revenue stream will make my taxes go higher. What can I do to avoid additional tax consequences? So Marie, this was exactly the point I was talking about before, which is great. So it's all a matter of what the stream of income you're going to receive. So let's say, I'll give you an example. There was a case I was working on that they already had different sources of income. They had rental, they had their social security, they had dividends that it was getting generated from their brokerage account. So turning on the pension, they didn't need the cash flow, and if anything, it was going to take them to the next higher tax bracket. So for this couple, it made more sense for them to actually take the lump sum and then defer it, and throughout the years maybe make some conversions. So then that way, when they reach 72, because keep in mind, any pre-tax dollars, whether it be pension, whether it be 401k, IRA, 403b, 457, these are all pre-tax dollars. They're called qualified plans. And at 72, you have to turn your RMD. Let's put it this way. That's what the income means in that world, meaning you have to take required minimum distribution. At 72, you're going to have no choice but to turn it on. So example, the case I was referring to, they were in their late 50s. So they were going to have a good 12 to 13 years that they could defer the pension, roll it out, let it grow, and convert along the way. So then they kept their the forward tax planning, not just for what was happening that decade, but more importantly, what was going to come ahead the decade after that. So I want you to keep in mind that as our country, we're going into more debt, and especially with the pandemic and everything that has occurred, we definitely are now trillions in debt, right? Well, the last I looked at, it was 26.5. That's not taking into account the new plan that will be, passed by either party. Part of that will be added to our national debt as well. So if we're accumulating all this debt, this means your taxes in the future could definitely be at risk. You may have thought, I'm going to be at a 24% tax bracket throughout all my retirement, or maybe you thought you were going to be at 15. Well, this could completely change your plan because these are rules, right, that are changed and set by the government. And any time your tax rate changes, so does your income and your cash flow. So it was really important for that case that I was working on, because they had that 12 to 13 years for them to look at converting some of their pre-tax dollars, their qualified plans. So it made a lot more sense for taking them as a lump sum, especially because they didn't really need the cash flow. So that's why it made perfect sense for them. Now, because of our experience being in the distribution phase of retirement, we have a lot of experience with that. So whether you're an existing client looking to retire and you want to run some numbers, or you're a guest of one of our clients, or you joined us from our community that had attended our events, don't hesitate to reach out to us so we can run some numbers for you and see what's the best pension option to maximize your retirement when it comes to income planning, protection from your family, and tax planning. Until next time, see you all soon. Bye.